Is America about to experience a recession? Navigating economic uncertainty. Recession, a term laden with anxiety, evoking images of market crashes, job losses, and financial hardship. As inflation persists, interest rates remain elevated, and global economic uncertainties intensify, a critical question looms. Is the United States poised for a recession? This analysis delves into the key indicators, offering a cautious yet informative perspective for investors, consumers, businesses, and economists alike. Recessions are not sudden events. They are the culmination of underlying economic imbalances. Identifying the warning signs is crucial for proactive financial planning and strategic business decisions. Let's examine the primary indicators suggesting a potential economic downturn. The yield curve, representing the difference between long-term and short-term interest rates, is a historically reliable recession predictor. An inverted yield curve, where short-term rates exceed long-term rates, signals that investors anticipate future economic weakness. Historically, an inverted yield curve has preceded recessions by 12 to 18 months. The current prolonged inversion of the U.S. yield curve warrants serious attention, suggesting a heightened risk of economic contraction. This inversion reflects investor concerns about near-term economic prospects compared to long-term growth potential. Consumer spending, a significant driver of the U.S. economy, is showing signs of strain. The robust spending seen in recent years, fueled by stimulus measures and pent-up demand, is unsustainable. Savings rates are declining as Americans deplete pandemic-era savings. Concurrently, credit card debt is surging, surpassing $1.1 trillion, indicating increased reliance on borrowing to maintain consumption levels. The proliferation of buy now, pay later services further underscores the pressure on household budgets. A decline in consumer spending could trigger a cascade of negative effects, impacting business revenues and employment. Business decisions reflect expectations about future economic conditions. When companies become cautious, it signals a potential slowdown. Job cuts in sectors like technology, coupled with reduced investment and store closures, indicate a contraction in business activity. These actions reflect concerns about declining demand and profitability. Businesses are proactively adjusting their strategies to mitigate potential losses in a weakening economic environment. The stock market, while not a perfect predictor, reflects investor sentiment and expectations. Increased volatility and market corrections can signal underlying economic anxieties. The S&P 500 and Nasdaq's recent fluctuations highlight investor uncertainty. While certain sectors, such as artificial intelligence, exhibit growth, others, like real estate and retail, face challenges. A significant market downturn could exacerbate economic fears and trigger further contraction. The Federal Reserve's efforts to combat inflation through interest rate hikes have significant economic consequences. While intended to curb price increases, higher interest rates can also dampen economic growth. Elevated mortgage rates are reducing home affordability, impacting the housing market. Rising auto loan delinquencies reflect the strain on household finances. Small businesses face increased borrowing costs, hindering expansion and potentially leading to closures. The delicate balance between controlling inflation and sustaining economic growth is a critical challenge. Despite the concerning indicators, several factors could potentially mitigate the severity or timing of a recession. A strong labor market, characterized by low unemployment, provides a buffer against economic downturns. Government spending on infrastructure and defense can stimulate economic activity in specific sectors. The growth of artificial intelligence and related technologies could offset losses in traditional industries. However, the extent to which these factors can counteract the negative forces remains uncertain. Economists hold varying views on the likelihood and severity of a potential recession. Understanding the range of possible outcomes is essential for informed decision-making. A severe recession could involve substantial job losses, a financial crisis, and a prolonged period of economic contraction. A moderate recession might entail moderate job losses and a slower recovery. In a more optimistic scenario, the U.S. could narrowly avoid a recession, but economic growth would likely remain sluggish. The most probable scenario, based on current economic data, points towards a mild recession in the near future. Regardless of the precise timing or severity of a potential recession, proactive financial planning is crucial. Building an emergency fund to cover 3 to 6 months of living expenses provides a financial safety net. Paying off high-interest debt reduces financial vulnerability. Diversifying income streams through side hustles or investments can enhance financial stability. Prudent spending habits and careful budgeting are essential for navigating economic uncertainty. The U.S. economy faces significant challenges, and the risk of a recession appears elevated. While the exact timing and magnitude remain uncertain, the warning signs are too prominent to ignore. A cautious and informed approach to financial planning and business decisions is essential for navigating potential economic headwinds. What are your thoughts on the likelihood of a recession? Share your insights and concerns in the comments below. Take control of your financial future today. Start building your emergency fund, reduce high-interest debt, and diversify your income streams. Don't wait for the storm to hit. Prepare now to weather any economic challenges that may lie ahead.